Alongside me is DeAnne Julius, a former member of the Bank of England Monetary Policy Committee, but also chairman of Chatham House. Thank you so much. It's a real pleasure to have you in the studio. There's so much going on in terms of regulatory reform, but also what the UK faces and giving more powers to the Bank of England, taking away from the FSA. Is this a bad choice?
Well, I think that something does need to be done to make sure that we have a unified monetary and financial stability look at the economy. I think that was one of the lessons we learned from this crisis, that you can't really separate the two in terms of deciding what policy instruments you need. Now, in terms of which institutions do what, I think there's no perfect solution. It seems to me that the downside of this is there will be a period of disruption. It's going to be hard for the FSA to find a new chief executive when nobody quite knows what the job entails. The upside, one hopes, is that there will be a more serious look at some of the macro risks to the economy from financial instability, not just inflation.
But do you believe that the banks actually have to be split in investment banks and retail banks? Would that protect the consumer in case of another crisis?
No, I personally don't. I think that there's no evidence at all that banks that do both were the ones most at risk from this crisis. Northern Rock was only in retail, Lehman's was only in investment banking. I think it's right to have a serious review of this, and if it's John Vickers, as has been rumored, who heads that review, then I think that would be quite a good choice. But it's a tricky issue, and it certainly has international repercussions, as well as repercussions here at home.
DeAnne Julius, are you not concerned that actually a lot of politicians are focusing on regulation as a way to do almost the easy solution as compared to taking the tough decisions of austerity measures? There's a lot of talk within the European Union also banning credit default swaps, these naked short selling, but there's no evidence in the market that this is what caused anything at all.
Well, I think the way I view it is that we really have three kinds of policies in this exit period. One is monetary policy, one is fiscal policy, but the third is regulatory policy. I think virtually everyone agrees that the regulatory structure did not serve us well going into this crisis. So it seems to me it's actually critical that governments make clear what the new regulations will be to remove some of that uncertainty that the financial sector and banks in particular feel right now. There should be a phased-in period of implementation if they are indeed tougher measures. But I think we really do have to get a grip on that. And part of the uncertainty and the weakness in the economy is simply because banks and other lenders do not know what kind of capital adequacy or other restrictions they'll face in the future.
Now, in terms of growth, we have the UK jobs data out today. Yesterday we had inflation figures. It must be very difficult being a Bank of England today, because at the one hand you have to deal with inflation, but of course you can't really raise interest rates. What's the solution?
Well, I think it's to wait and see, frankly. I mean, when I was on the committee, almost always there was some reasonable argument to do one thing or the other. In a way, today's situation is a little bit easier because I think no one expects a significant tightening of monetary policy in the current circumstances.
But do we need to put extra quantitative easing in there?
Not in my view. I think the fact that it is now on hold is the right situation, and if it can be worked off gradually, I think that's probably the best solution for the economy.